Hello, my name is Dr. Apollo. So, we're going to continue the discussion of accounting principle. So this time we're going to angle on going concern principle. So what is this going concern principle? So what's this all about? So what this can uh, do in accounting? So this principle assumes that business will continue operating in the foreseeable future without the need for liquidation or significant restructuring. So this principle underlies financial reporting because it allows business to record assets at historical costs rather than liquidation value and to defer expenses to future periods. No? So what are the assumptions of these principles? So one is the company will not cease operations or liquidate in the near future. Another, assets are recorded at cost rather than liquidation value. Take note of cost. No? Liabilities, these are the payment. Huh? Owed by the company to other institutions like banks, people. No? So will be paid off under normal business operation. So long-term investments and expenses can be deferred over multiple periods. So take note of this. Example, so depreciation of fixed asset. So a company buys machinery for $500,000 with a 10-year useful life. So under a going concern principle, under this principle, how it will be treated, the depreciation of fixed asset, the company spreads the cost over 10 years. So that means it will be multiplied. It will be divided by 10, no? Instead of expensing it immediately. Another is a long-term loan repayment. So for example, any debt you owe by the company to by the organization to another company lender, no? So here, a business takes out of 5 million bank loan payable over 15 years. Example, no? Since the company is assumed to continue operation, that means perpetual, it records the loan as long-term debt rather than immediate liability. So the payment is very light, okay? But the interest very high. No? For example, government, an organization government, uh, uh, asking for loan 10 billion payable in 35 years like that. So the charges is very small interest, but the total interest will be 15 billion after 35 years. It's like that. So another is deferred revenue and prepared expenses. How is the principal work on this one? Deferred revenue. So collections that uh, to be received some point in time. No? Okay, example, a software company receives 100,000 in advance payment for a 5-year subscription. So this is the case, no? So the company recognizes revenue over 5 years, not late. Assuming it will continue providing the service during that time. Okay, deeper. So when going concern principal fees, what is this principle's downside, no? So case if a company likely to shut down, enter bankruptcy or undergo liquidation. That's the problem, okay? Financial statement must adjust asset values and disclose this as the auditor's report. So nobody wants to end their operation because of the assets problem, okay? Loan problem. Example, a retailer facing severe financial losses is unable to secure funding and plans to close all of stores within a year. Okay? So X means problem. No, the going concern assumption is no longer valid, and assets must be reported at liquidation value instead of historical cost. No? Okay. So indicators for going concern issue, financial indicators. No? Consistent operating losses, negative cash flow, inability to pay debts. No? So these are the issues, problem. Okay, operational indicators, loss of major customers or suppliers, legal or regulatory issues. So these are problem there. Okay, external indicators, the bankruptcy filings, industry-wide decline. In bankruptcy filing, there are many requirements that incur losses to the. So comparing this principle with the ongoing principle with accrual matching and prudence principle. So the ongoing concern principle, GCP ensures accrual-based transaction makes severe over time, where accrual principle, revenue and expenses are recorded when incurred. Na? So in matching principle, the GC concerns justifies uh, deferring certain expenses across multiple. So in matching, expenses are matched with revenues in the same period. So with prudence, so this principle, if going concern fails, the prudence principle requires business to write down asset values. Because prudence losses are recognized early, but gains only when realized. Okay, so importance of the going concern principle. So ensures number one, ensures accurate financial reporting. So when it comes to accuracy, which is the downside with that principle. Here allows for long-term planning of expenses and liabilities. So facilitate business decision making. So it helps. Assist management in making investment and expansion decision because it's long-term. So another influences investors and creditors confidence. So this is stable. Investors and lenders relying on concern assessment for financial stability. Regulatory compliance required under GAAP and IFRS. GAAP is US based. Now IFRS is more Middle East or European. Okay, so the problem here is subjectivity in assessment. Determining, in the case of company, will remain operation requires just subjective, not objective. So that means that this is changeable. Huh? Another external factors can change quickly. Market condition, legal issue, global crisis can suddenly accept by everyone. Misuse of or misrepresentation. Some companies might overstate financial health to avoid going concern. Okay? So these are the problem that these principles is going concern principles is a downside. Okay, that's all for our discussion for this principle going concern. So we will discuss other uh, principles. No, thank you for having with me.